What's up, guys? Roger and Norv back. Episode 2. Today's March 4th, 2022. So today we're going to give you a couple of scenarios on mortgage rates if you're looking to buy or refinance. Norv has some big news in the market, and then we're going to talk about how that news is going to affect the real estate market. So really quick. So if you're buying a house today and you're putting 20% down, you have a 760 FICO score. So your credit score is excellent. If you're buying $1 million home in LA, Orange County, San Francisco, San Diego, you're buying $1 million home, putting 20% down. You're looking at a rate of 3.94% with about a 1% origination cost. That's what you're looking at as of today. So just under 4%. If you're looking to cash out on your home at 70% loan to value, you're looking at about a 4.5% rate. So that's where we're at as of today. And Nor, we have some big news. So tell us what's going on.
Yeah, so those are great rates, Roger, for where we are today, considering where we could be in reality if this war wasn't going on. And the news is just that after the testimony from the Fed yesterday, Jerome Powell in front of Congress, the war is center stage, but inflation is supersedes all of that, and they see the inflationary pressures that the war can cause as well as like the pressures that are there have been there. And so it's a cause for concern, and they've made it. It's a foregone conclusion that rates will go up. They will raise the Fed funds rate. About 5 times it's projected to go up this year. So, they did also make a statement that had that in hindsight they should have done this earlier. So, we know now that they're playing from behind, and that if it wasn't for this war, those rates would not exist. We'd be up above 5%.
Wow, already. Guys. Wow. Okay. So you heard it here first. Rates are gonna hit 5%, depending on what happens with this war, right? So if this war wasn't happening, as Norv just said, we'd already be at 5%, and we're not that far off. So once this war is over, the rates are going. I mean, they're projecting 5 rate hikes. So do you think that 5 rate hikes are going to happen this year?
It's there, some of the analysts out there have those projections for this year for every single meeting, about a quarter. Now that's I guess you can't really say if it's conservative or not, but that's the baseline. And if things sort of, jobs report came out today, beat expectations by 300,000 jobs, and then so you have a lot of other factors that the Fed's looking at, and all of those are pointing towards higher rates. And it all kind of depends. Nobody really knows the impact that the war is going to have on supply chains and things of other sorts along the global economy. But one thing is for sure, and hopefully the war stops quickly. It's unfortunate with everything that's going on, but the moment there's a ceasefire or anything of that sort, you might, the Fed might do 50 basis points. It's not out of the picture, right? So we're pricing in a quarter. So rates, and I believe as well, just from everything from hearing everything I heard from the Fed yesterday, that had this war not happened, not been the case, we would already be above 5%. And so all of this kind of still depends on the war. If it does escalate and nuclear threats are there, and really things start picking up where there might potentially be a world war, and it could be catastrophic for a lot of different countries and the economy, then it's a completely different ballgame. So there is that caveat, but everything's pointing higher.
Okay, well, hopefully not. Hopefully we don't get to that point. But so rates are going up. That's like, long story short, rates are going to be 5% or more in the coming 6 to 12 months. So what that means for the real estate market. So as you guys know, if anyone watching this has tried to buy a house in the last year, the last 6 months or 3 months, it's very, very difficult to get an offer accepted. Norv and I we're even like looking at buying some investment properties. We were competing against 27 other offers. So there's a huge imbalance. So what's the good news here? There is some good news that are going to come from these higher rates, guys. As rates go up, right, it's going to even out the supply and demand, right? So there's going to be less buyers because A, they're turned off by higher rates, or B, they don't qualify. If rates go to 5 or 5.5%, there's going to be a chunk of buyers that are like, all right, I don't qualify anymore. I can't afford to buy these houses. So instead of 27 offers, you might see 10 offers. So if you're a buyer out there and you've been frustrated or disheartened by this market, there may be some good news ahead. Yes, your rate will be higher when you buy a home, but in the future, there will always be an opportunity to refinance and lower your payment. So for the home buyers out there that have got kicked in the gut, competing against 20 people trying to buy a house and have been unsuccessful, there is some light at the end of the tunnel. I think this is going to help buyers, and it's going to help even out the real estate market because it's way too skewed towards the sellers. Like the sellers have all the leverage and advantage. And I think these rates going up is really going to help buyers try to secure a home, which we desperately need more balance in the real estate market. It's just way too, skewed towards the sellers. So any last things you want to add before we sign off?
No, well said. I mean, that's pretty much as far as like everybody knows, and we've been able to follow up in the Fed statements on that. And it's just to recap everything. It's a foregone conclusion. It's there, and what you said will likely happen as far as the impact that it'll have on real estate prices or the supply and demand portion of it. But one thing's for sure is that they're watching it closely, and they did also say that they will push the envelope, if you will, to try to cap inflation as far as they need to go to make sure that it doesn't spiral out of control. So that's going to happen.
It needs to be addressed. The only way to address it is raising rates. So that's what they're going to do. So thank you guys for watching.
Thank you, everyone.
Appreciate it, and we'll see you guys on Monday.
Thanks, Roger.
All right, bye.